Welcome to Deloitte's Debrief Tax webcast series in Asia Pacific. Our webcast today is from our Geography Update series and is titled 2021 Japan Tax Reform Proposals, the Pursuit of Shifting Policy Priorities. My name is David Bickle and I'm a tax partner based in our Deloitte Tokyo office, and I have the pleasure of hosting today's webcast. And I have four speakers with me today: Stephen Baker, Brian Douglas, Ken Leong, and Srini Menon. Now, Stephen and Ken are tax partners in our financial services and business tax services groups, respectively. And Brian and Srini are both directors, with Brian working together with Ken in business tax. And I'm pleased that Srini is joining us today here from our tax technology team. And all are based with me here in Japan, and we're not working from home, are located in our Deloitte Tokyo office. For further details, you can see our bios on the left-hand side of the screen. Now, before I introduce the agenda for today's webcast, I'd like to take a moment to highlight some of the features of the webcast console. First of all users are on listen-only mode. And if you have any content-related questions, you can submit these at any time in the Q&A box at the bottom right-hand side of the screen, and we will do our best to respond to those questions during the course of today's presentation. Secondly, all PC users can maximize or minimize each box at their convenience during the webcast, and you may also explore the icons at the bottom of the screen. And also, if you wish to download slides and related publications, please go to the Downloads and Links box. Alternatively, if you are on the move today and are viewing from a mobile device, you can also see all of today's slides on your screen, and you can also reply to survey questions as well. And thirdly and finally, if you require an attendance record for this event, you can download your CPE certificate by clicking the Request CPE icon at the bottom of the webcast console. Okay, so let's turn now to the theme of today's event and the topics we're going to cover. As a quick reminder, the title of the webcast is 2021 Tax Reform, Pursuit of Shifting Policy Priorities. Now, over the last 4 or 5 years, the content of the annual Japanese tax reform has been driven by the policies of Japan's longest-serving Prime Minister, Shinzo Abe. In particular, measures reflecting his growth strategy, which together with fiscal stimulus and aggressive monetary policy made up the three arrows of his signature approach to rejuvenating the Japanese economy, commonly referred to as Abenomics. Now, as most listeners will know, Prime Minister Abe stood down last September and was replaced by the former Chief Cabinet Secretary, Yoshihide Suga. Now, whilst it's probably a bit early to be talking about Suganomics, too early for that to become a household name in the way that Abenomics did, this year's tax reform most certainly reflects the new Prime Minister's own policy priorities. These are shaped in part by the experience of the COVID-19 pandemic, in particular the desire to have more resilient systems of business operation, and also an economy that will not only grow, but will grow sustainably into the future. Now, in line with this, we see measures designed to promote digital transformation and also the pursuit of carbon neutrality, which, like several other countries, Japan has pledged to achieve by 2050. Japan has also stated its desire to bolster its financial services industry, which is a sector in which it has lost some ground over the last 10 or 20 years, particularly to regional hubs such as Singapore, Hong Kong, and also more recently to some of the hubs in mainland China. In particular, Japan is looking to encourage the expansion within the financial services sector, encourage the expansion of investment management activity, particularly here in the capital of Tokyo. So together, these three policy goals, firstly, digital proliferation, pursuit of sustainable growth, and promotion of aspects of financial services, these provide a framework, I think, for organizing and looking at the contents of this year's 2021 tax reform. Amongst these, the drive towards digitalization is having a major impact on the way in which businesses operate. And this change, I think, would likely have happened regardless of COVID, but certainly the response to the pandemic and the pursuit of greater resilience has certainly been a catalyst for more rapid change. Accordingly, we'll begin today by looking at the current environment for digital transformation in the tax space in Japan, particularly the tax operations and technology, and also digitalization, by which I mean the transmission is necessary to store financial records and information in digital format, which of course will enhance accessibility, storage costs, and importantly, during this time of the pandemic, can also reduce the need for physical touch points and paper processing. We'll then move on to examine the investment incentives in the tax reform that the government hopes to encourage taxpayers to spend, the breadth and depth of digital infrastructure. And staying on the theme of incentives, we'll then look at changes to measures available to boost R&D expenditure. After that, we'll close our discussion of digital by casting our eyes to the horizon to see what changes are coming next in this space that inbound investors should be aware of. And from there, we'll shift to the theme of carbon neutrality and specifically to the incentives designed to encourage investment in support of this important goal. After that, we'll look at the initiatives designed to remove some of the perceived impediments that have acted as a drag over recent years on the development of financial services here in Japan, particularly the treatment of directors' compensation for tax purposes and also carried interest. And we'll also look at the latest refinements made to Japan's inheritance tax system. Finally, we'll wrap up with a couple of other important topics, including changes to the utilization of tax attributes, specifically certain types of NOL or net operating losses, and also some changes to the treatment of M&A activity, certain M&A transactions here in Japan. Then with luck, hopefully we'll have succeeded in managing our time well enough to allow us a bit of space to answer some of the questions that we hope will come in during the course of this presentation. Okay, so I think that's enough from me, and I'd now like to turn over to our panelists and move on to today's discussion. So it's been a year in which we've been hit by pandemic, and in most countries around the world, we've seen moves to teleworking and to a greater or lesser extent still going on to a work from home model. So how is Japan adapting and adopting these changes into its daily life, our daily life? Srini, I think this is your field and something I know that your team focuses on and closely monitors. So over to you, please. I'd be grateful if you could take us through some of the changes and the trends that you are seeing and the impact of those changes on the spread of technology, particularly here in the tax space.
Thank you, David. Sure, let me share. So we have been supporting and watching how our clients are adopting teleworking. So based on various surveys, we could see many interesting trends about teleworking. So let me share some. Based on OECD findings, in terms of information, communication, technology, utilization, and aggregation, the digitalization rate in Japan workplace is 50%. The ICT is delayed compared to other countries like the US is 63%, Germany is 59%, and France is 54%. The Tokyo Metropolitan Government Survey conducted in mid-2020 shows that teleworking increased up to 57% compared to December 2019. Of course, some industry has its difficulty due to the nature of the work and lack of innovation. The low industries are mostly transportation, postal, medical, nursing, and welfare. Also, they are also facing an increase in workload. By end of 2020, the teleworking issues are generally on decline. However, the 43.9% of the people feel that working from home decreased productivity. The main reason, around 68% of the people, is thinking that lack of working environment, especially home equipments, working with external parties like a bank, auditors, vendors, and tax officers are causing the problem. So another survey result is long working hours. The November 2020 result shows that 25% are subject to 10% in March, basically. However, the similar survey conducted in the US shows like around 77% of the people don't think there is any increase in workload and working hours. Thank you, David.
Yeah, and I think Srini, I think maintaining a healthy work-life balance certainly requires a lot of self-discipline at the best of times. And when working from home or for an extended period of time like we are now, it's certainly a challenge, a great challenge for many people, particularly those who are juggling responsibilities of childcare or also looking after other dependent family members. But what about the other challenges that are holding companies back from helping the people, their employees, their talent to work more efficiently remotely?
Yes, sure. Let me share it. So let me share some of the challenges that I received from the surveys, actually. So the many companies still are on temporary solution to support emergency without a long-term strategy. The second one is not all the business applications available for teleworking. That's a big challenge. The third one is the non-digitalization of the back office process, especially HR talent, tax accounting, the approval flows, contract stamping. These are causing challenges for the teleworkers. And also, they feel we need a better tool for face-to-face communication with the privacy is a must to build a trust. The small and medium companies taking bold steps towards the paperless rather than corporates. The many corporates tend to be focused on temporary solution, maybe due to the fear of security or regulations. After the spread of vaccine news, more than 30% of the people thinking going back to the work for the above reasons, actually. But still, 40% of the people have not decided yet, and they like to continue teleworking if possible. Thank you, Dave.
Thanks, Srini. And now, one of the major issues that has received a lot of media coverage during the early stages, at least, of the pandemic was the Japanese custom of using official seals, seals to authenticate documents by physically stamping them. And this was causing certainly a significant number of people to have to travel into the offices where the official seals are stored for security purposes, and also papers, physical papers, bits of papers to be stamped are being circulated. Now, it seems that the Japanese government has made quite a bit of progress in terms of abolishing the use of seals, at least for official documentation, and is instead moving to digital modes of authentication. So with that in mind, could you please let us know what's been happening on this topic in the tax space?
Okay, thank you, David. Yeah, sure. So to support digitalization, the 2021 tax proposal suggested to remove the seal requirement for the many documents, such as income tax, corporate tax, consumption tax, inheritance tax, and the gift tax returns. Also, the many notifications of various tax items are removed from the seal requirement. But please note that some documents still need a seal. For example, a consultation on a division of property among attached documents. Under the special provision of inheritance tax or gift tax, we still need a seal. So please watch those documents, requirements. Thank you, David.
Okay, Srini, thanks for that. And what about the recent changes, though, to the Electronic Books Preservation Act in support of faster digitalization, faster moves towards digitalization? Just as a quick reminder for people dialing in today, the Electronic Books Preservation Act is the act that deals with the digitization of national tax accounts and related tax documentation.
Sure, thank you. To encourage a faster transformation, the proposal is to remove some of the major challenges that taxpayers faces currently. The first one is approval from the tax office in advance for books, documents, and scanner storage. This will be abolished. Another major change is a search requirement reduction. The search items can be reduced to date of transaction, transaction amount, and business partner. But the companies decide to switch from paper to electronic format still need to follow all other requirements like preparing the design documents, operational manual, operational flow diagram, and storage requirements, etc. The major change to Article 4.3 are timestamping a receipt from 3 business days to maximum of 2 months. Reduced search requirements, same as above. Abolishing the self-signing of documents. The periodic verification and keeping originals. These are the changes. Well, we see there's a lot of benefits coming in, and tax credits also probably coming in. However, the penalty will be increased up to 10% in case of falsification or mistake of the records on top of the original tax. Also, please note that an electronic record which does not satisfy the requirement will not be treated as a national tax-related document. So please be careful. So please note that the above changes are applicable only on or after January 1st, 2022. The tax benefit, especially the reduction of additional tax for the understatement, and the penalties, addition of substantial additional tax, will be applied to national taxes. Those statutory due date is on or after the same day, January 1st, 2020. Thank you, Dave.
Okay, thanks very much for that, Srini. And hopefully these moves to strip away some of the upfront administrative effort to prepare the various applications to go forwards with e-documentation will encourage more companies to make use of electronic storage of documents. Very much a carrot and stick approach, though, with the elimination of the pre-approvals counterbalanced by the introduction of tougher penalties there for non-compliance. Okay, so moving away from the process of going paperless, I'd like us to turn now to look at some of the initiatives proposed in the tax reform that the government hopes will stimulate the spending and investment in digital capabilities. So, Brian, can I invite you to come in here, please, and take us through this?
Sure, David. So for many businesses, the pandemic highlighted the importance of digital transformation and having the infrastructure in place to allow remote working and the ability to communicate with colleagues, clients, and customers online. And as Srini mentioned, many companies in Japan have temporary solutions or patchwork solutions in place, like some employees being able to telework, but others not. Being able to access certain applications remotely, but not all applications. So to encourage companies to invest more in their comprehensive digital transformation, the 2021 tax reform provides a tax incentive in the form of either special depreciation, which is a partial immediate write-off of the acquisition cost of an investment, or a tax credit of 3 or 5% of the acquisition cost in certain eligible assets. Now, in order to qualify for this incentive, a company must first have Blue Form taxpayer status. Now, this is a status that is generally granted to companies who maintain proper books and records. And second, have a business adaptation plan certified under a to-be-revised law called the Industrial Competitiveness Enhancement Act, or ICE Act for short. Now, this incentive will apply to investments made in eligible assets between the date of enforcement of the ICE Act, which we expect to be sometime in July this year, and the 31st of March 2023.
Okay, thanks, Brian. And you mentioned on the slide eligible assets include software, deferred assets, and any equipment used in connection with the software or deferred asset. So can you just please explain what you mean by deferred asset? This seems something that seems to leave a lot of people puzzled.
Sure. So deferred assets they're generally costs incurred by a company whereby the benefit of incurring that cost is expected to last more than 1 year. So one example of this are startup costs incurred in starting up a business in Japan. Now, the significance of this is that these are costs that are treated as assets and amortized over a specific period of time for tax purposes. And I think in the context of the digital transformation incentive, we expect that the initial cost associated with moving legacy systems to the cloud would be considered a type of deferred asset. All right. Moving on to the next slide. Investments in eligible assets. These investments must be made in accordance with a certified business adaptation plan. Now, while details of the process and the contents of the plan are light in the proposal, Materials on the website of the Ministry of Economy, Trade, and Industry, or METI for short, provide some information indicating that there are two broad categories of requirements to include in the business adaptation plan, and those are digital and business transformation. And regarding the digital requirements, companies will need to show how they intend to use cloud technology and share data while ensuring its digital systems are secure. And regarding business transformation requirements, companies will need to show how these investments will boost their productivity. And as part of the submission of the plan, minutes of the board resolution approving the business plan will need to be included, suggesting that this transformation needs to be a company-wide transformation. So in the end, this incentive can be quite good for eligible companies. Up to 5% of the investment may be a dollar for dollar or yen for yen offset against the company's Japanese tax liability. However, there will be some planning and administrative necessary, including dealing with the appropriate government agencies in charge of certifying the business adaptation plan before this incentive can be applied.
Yeah, thanks for that, Brian. And I think it's, as in common with with most annual Japanese tax reforms, you mentioned that there are not many details available yet in the proposal. So do you have any idea when more details are likely to emerge and become available to us?
Yes. So we expect that these proposals, as is typical in most years, to be enacted by the end of March. And around the same time, we would expect some further guidance in the form of cabinet orders. So perhaps by April, we will have a better understanding of what is required of companies to take advantage of this incentive.
Okay, thanks, Brian. Now, let's move on from the digital investment incentive and take a look at what's been happening in terms of the R&D tax credit incentive. I know this is not a new incentive, but certain aspects of the regime are changing in recognition of the fact that more companies are moving towards the provision of cloud-based technologies. So can you please give us a quick briefing on what's available in this space in terms of the proposals in the tax reform?
Sure. So there have been a few proposed revisions to the R&D credit system. And this diagram summarizes the different regimes within the R&D tax credit system and some of the proposed revisions. So, for example, there are changes to the calculation formula and increases to the credit limitation, at least for companies that maintain their R&D spend despite having reduced revenues. And David, the change I think you're referring to relates to the change in scope of what is considered an eligible R&D expense. And that's the proposed change that I'll focus on today. And I think the best way to do this is through an example. On this slide, you see two diagrams, both showing a company, a developer incurring costs to develop software. Now, the diagram on the left side shows a software developer creating software and delivering to users as packaged software. Now, this was a common business model in the past where software was developed, put onto a CD, and sold. Now, all the research and development costs associated with developing this software, so-called software for sale model, are generally deductible for tax purposes and are treated as an eligible R&D expense, meaning it can be used in the calculation of the R&D tax credit. Now let's contrast that with the diagram on the right side, showing a software developer creating software, but providing this software to users via the cloud. Now, the way the Japanese tax rules work, the research and development costs associated with developing this software, so-called, for example, software as a service model, are actually capitalized and treated as an asset for tax purposes. And those costs are not eligible as R&D expenses under current rules. Now, the reasoning behind this difference in treatment is a bit complicated, but in any case, given that many technology companies are moving or have already moved to providing software via the cloud, the R&D credit system was becoming less effective. So under the 2021 tax reform, R&D costs associated with the development of software to be provided via the cloud will now be treated as an eligible R&D expense.
Okay, thanks for that, Brian. And it's good to see the tax system being changed to keep pace with the developments in technology. Now, before we leave digital and technology behind completely, I'd like us to stay focused on the future for a few more minutes, and for us to use that time to see what's coming up next over the horizon in terms of digital developments that we can expect to be impacting on tax going forward. So, Srini, if I could bring you back in again, please. I'd like to ask you to share with us what we should be keeping our eyes open for going forward in the tax space in terms of the future of digital.
Okay, thank you, David. Sure. So let me share some of the insights. So in the World E-Government Ranking 2020 published by UN in July 2020, Japan was ranked as an advanced country of e-government. However, it was dropped from 10 to 14 than 2018 survey. To reach back to the top position with a decreasing population, Japanese government is aggressively looking to promote e-government and technology-driven business growth. The 2020 Asia-Pacific SMB Digital Maturity Study shows Japan's GDP will grow from 44 billion to 52,000 billion yen by 2024 if SMEs are digitalized. Japan's goal is to achieve 100% system-readable, standard formatted electronic document, not digital document. So let me share what is the difference. An electronic document is a document created by the software from the beginning, and the digital document is a document obtained by scanning a paper document with the scanner and digitalizing it. That's very common in Japan now. Also, to support decentralized economic growth, to increase and move the economy pocket from larger cities to smaller cities, and reduce the impact of real estate crashes and this pandemic like that. So let me share some of the upcoming DX promotions. So e-government initiative. Japanese government is looking to accelerate the realization measures by drastically improve the my number system, digital infrastructure through national and local offices, acceleration of standardization, construction of interfield data linkage platform, promotion of open data. These are added to the basic policy. As an example, data collaboration. To promote public-private data sharing using cloud services to reduce, rebuild similar data application, data, and infrastructure. As Brian mentioned about earlier, there is an extra tax credit for this. So hopefully this will be expanded to more areas too. IoT and AI. The government like to see how companies to use AI and IoT to improve the labor productivity, efficiency, and quality. Some of the promotions are already started under a variety of initiatives like IVI and MPC, and we hope to see more tax credits come on those areas too. So let me share another practical move. It's called the e-invoice. From October 2023, a qualified invoice format will be introduced. So this is to share the system-readable, standard formatted electronic document between companies. I'm sure there will be an extra tax credit to support this move. And hopefully, we will see more and more this kind of initiatives in the future. Thank you, David.
Yeah, thanks very much, Srini, and in particular for mentioning the qualified invoicing fact. This is not something that taxpayers can resolve on their own, and I think it's worth bearing that in mind, as they'll also need to ensure that the vendors in their supply chain are able to provide invoices in the correct formats going forward. Thanks also for reminding us about the important definition and the differences between electronic and also digital documents. Okay, so with that, let's stay on the theme of incentives and take a look at those proposed in the tax reform for the purpose of promoting investments that will contribute to carbon neutrality along the theme of sustainable growth. Ken, if I can invite you to come in here, please, and take us through these proposals for investment incentives for carbon neutrality, please.
Yes, thanks, David. As you mentioned in your introduction, Japan has declared its intention to achieve carbon neutrality by 2050. And in order to achieve this goal, the government intends to implement a wide range of measures which include the revision of existing tax laws or the introduction of new tax laws to promote activities or investments which reduce carbon emissions. So it's not surprising that this year's tax reform package includes new tax measures in this area. So in summary, an eligible company which acquires an eligible asset can choose to claim at its election special depreciation equal to 50% of the acquisition cost of the eligible asset, or a tax credit equal to 5% or 10% of the acquisition cost of the eligible asset, capped at 20% of the company's corporate tax liability. An eligible company is a company which submits blue form tax returns and which has submitted a medium to long-term environmental adaptation plan, which has been certified under the amended ICE Act, which Brian mentioned earlier. It's expected that further guidelines will be issued regarding the information to be disclosed in this plan and other relevant requirements. So looking at this slide, you'll see that eligible assets fall into two categories. Based on information issued by METI, the first category of assets are generally facilities which reduce the emission of greenhouse gases by improving the efficiency of production processes. The second category of assets are generally facilities exclusively used for manufacturing of products which reduce the emission of greenhouse gases. An example given by METI are fuel cells. For both categories of eligible assets, they must be acquired and placed in service between the effective date of the amended ICE Act and March 31, 2024. And a final point to note is that the total acquisition cost of eligible assets cannot exceed 50 billion yen, approximately $483 million US.
Yeah, thanks, Ken. And you mentioned that a company may choose between special depreciation and a tax credit. And in the case of the latter, the tax credit is either 5 or 10%. Can you just give us a quick idea as to which assets can qualify for the 10% credit rate, please?
Yes, the tax credit is in general 5% of the acquisition cost of the eligible asset. However, the tax credit rate for assets that significantly contribute to the reduction of greenhouse gases is 10%. So these assets are likely to be included in the first category of eligible assets, being facilities which reduce the emission of greenhouse gases by improving the efficiency of production processes. I also mentioned that the tax credit is limited to 20% of the company's corporate tax liability. So when we calculate the 20% cap, we should also take into account any tax credit claimed by the company under the tax incentive for digital transformation investments, which Brian mentioned earlier. Back to you, David.
Okay, thank you, Ken. And I think that's a good point on which to wrap up our discussion of the green incentives. And from here, I'd like us now to move to the third pillar that I mentioned before, the third pillar of activity around which we can organize today's discussion, and that's the development of financial services. So, Stephen, you've been waiting very patiently, and I'd like to bring you in now, please, into the conversation. Could you please begin with the first issue I mentioned earlier, which is the profit-linked or the treatment of profit-linked directors' compensation?
Thank you, David. So, as David mentioned earlier, Japan is hoping to draw more of the financial services practices onshore. In support of this goal, the 2021 tax reform included changes to profit-linked directors' compensation. Now, our slide provides a brief summary of what is actually being addressed. Generally, directors' compensation is excluded from what is considered tax-deductible salary or bonus amounts. However, certain exceptions do apply. Monthly fixed payments, advance notification payments, and profit-linked compensation may become deductible if certain criteria are met. Profit-linked compensation and its underlying calculation method that are both disclosed in an annual securities report by a listed company is one of those exceptions. However, unlisted asset management corporations are not required to file an annual securities report, and therefore they're not allowed to take this exception. The tax provisions create the opportunity for these non-listed investment management corporations that file a blue tax return and qualify as special investment managers to receive access to this deduction. But as one might not be surprised, the details do matter.
Yeah, thanks, Stephen. And just to clarify, the scope of this rule seems to be quite limited, so just benefiting certain investment management businesses?
That is correct, David.
Okay, thanks very much. So with that, could you please take us through some of the details that you just mentioned?
Sure. Let us take a look at the next slide to examine a few of those details and see what we see. So now, for purposes of the tax provisions, a, quote, special investment manager is a corporation whose ratio of total profits from certain specially permitted businesses to total profits for the current year is 75% or more. Quite a mouthful. And right now, we're aware of about 4 classes of operations that appear to qualify under this new definition. The first is the investment management business of financial instruments business operators. The second, specially permitted businesses for qualified institutional investors, i.e. of specially permitted businesses notifying of such. The third category, specially permitted businesses of foreign investors. And the fourth category, an even bigger mouthful, specially permitted businesses for the transitional period for a person who provides those specially permitted businesses for the transition period noted above. So quite a lot to think about there. Please note, though, that the definition of a special investment manager does not include companies submitting an annual securities report or their wholly owned subsidiaries. This bit about wholly owned subsidiaries is the part that people will really want to pay special attention to. Now, in addition to qualifying as a special investment manager, that party must ensure that the profit-linked director compensation be limited to some type of objective criteria based upon the profits generated from the investment transactions or investment activities, if you will. Now, this investment manager must also ensure that investor approval conditions are met, and that can happen through one of 2 mechanisms. The first is where the fund contracts or the asset management agreements, they include provisions that the profit-linked compensation will be paid and the method of calculation. Sort of everything is set from the document stage forward. The second method is that prior to the fiscal year in which the compensation is going to actually be paid, the existence of and calculation of that performance-linked compensation is reported at a meeting of the limited partnership or the investor group. That report is actually maintained in the minutes of that meeting. And third, that there is no record of objection, if you will, that was made by any of the parties or investors. So there's a little bit of housekeeping to be maintained during this process. Now, this change will hopefully create opportunity for more profit-linked compensation in a less complex manner by enabling direct profit-linked compensation as opposed to a series of legal but more complex steps that companies have to contemplate. So this is a small step in leveling the playing field for certain investment companies, but a welcome one. And with that, back to you, David.
Okay, thanks for that, Stephen. And let's move on now and look at the second of the financial services related issues that I flagged earlier. And this is the treatment of carried interest. And maybe just to set the scene, it would be great if you could please just outline initially what we mean by carried interest in this particular context.
Certainly. So let me make a few introductory remarks along those lines for those not very familiar with the concept. This distinction for carried interest is based upon the difference in tax rates, if you will, applicable to salaries and service fees on one hand, and those that are applicable to capital gains activities. As the bottom half of our slide will show you, the national tax rate rises as high as 56% on salary and service fee income. Now, in comparison, the tax rate of capital gains is a flat 20%, but to be fair, it's actually 20.315% if you include the earthquake surcharge. So now let's turn our attention to the top half of our slide. The top half of our slide illustrates the distinction between partnerships or funds that are impacted and those that are not by the 2021 revisions. Carried interest specifically is a form of compensation paid by certain partnerships that are investing in or trading equity securities, the illustration at the top right-hand side of our slide, if you will. Now, carried interest does not arise in the context of fixed income or real estate investment partnerships. So you see on the left-hand side. Now, under traditional partnership tax, allocations are made usually through reference to a partner's capital contribution. Limited partnership investment managers of these equity-based funds may receive an allocated return of partnership capital gains that is in excess of that would be determined solely for their investment contribution. The allocation key is often tied to a single or multiple internal target rates of return for the partnership. Now, in private equity funds, it is not uncommon to see a limited partner receive up to 80% of the capital gain amounts that would be considered carried interest. With that, under current law, the transparent nature of partnership compensation and disclosure have been helpful in this environment. Key criteria, as we mentioned earlier, is that carried interest be reasonable. But once again, in the details, reasonable has not been defined as of today. The FSA has been relatively taxpayer-friendly in this item, but there's a little bit of grayness that we're hoping to address. The proposed tax revisions include instructions to provide more guidance and clarity to increase certainty of treatment. The FSA is expected to provide more detail in this area, hopefully this coming April, in fact. Now, again, the move towards clarity is welcome in an environment where errors are costly and damaging. This further supports Japan's attempt to become more of a financial services center of excellence and hopefully shows their intent to continue moving in that direction. So with that, back to you, David.
Thank you, Stephen. Now, another item that many foreign nationals have concern about when moving to Japan is the applicability of Japan's inheritance tax laws to their overseas assets and properties. There's been a beneficial proposal in the 2021 reform. So, Brian, can I bring you back in, please, at this point to walk us through what's in this proposal?
Sure, David. So for background, whether gift or inheritance is subject to tax in Japan depends on several factors, including the situs of the property being transferred, the nationality, visa type, and duration of domicile of the parties involved in the transfer. Now, this table summarizes the tax implications of various scenarios based on those factors, with the green shaded area depicting a scenario where the transfer of overseas property is subject to tax, and the white area indicating that the transfer of overseas property is not subject to tax in Japan. And the 2021 tax reform proposes to change the factor highlighted in red on this table. Now, let me provide a few scenarios to illustrate how this proposal is beneficial. And let's call this first scenario Scenario A. So if a foreign national with a temporary visa, like a work visa, domiciled in Japan less than 10 years out of the last 15 years, this is the current threshold, gifts or they gift or bequeath overseas property to a foreign national who has never been domiciled in Japan, well, that transfer of that property would be outside the scope of Japanese inheritance and gift tax. However, if that same foreign national was domiciled in Japan for, say, 11 years, and let's call this Scenario B, that same transaction would be within the scope of Japanese inheritance and gift tax, and the recipient of that property would need to report and pay such tax in Japan. Now, the proposal essentially ensures that the inheritance or gift tax will not be imposed on the transfer of overseas property in Scenario B by eliminating that duration threshold of the transferor. So in other words, the transferor can be domiciled in Japan indefinitely without triggering the inheritance gift tax. Now, please note that the duration threshold, being domiciled in Japan for 10 out of the last 15 years, does not change for the transferee or the individual receiving the property. So if the individual that was domiciled in Japan for 11 years in our previous scenario, and let's call this new scenario Scenario C, if that individual receives a gift or inheritance of overseas property, even if it's from a foreign national who's never set foot in Japan, the receipt of that property would continue to be taxable in Japan even under the 2021 tax reform. So while this proposal does provide a benefit for some foreign nationals in certain scenarios, if the purpose of the proposal is really to encourage foreign talent to move to Japan, it's not quite clear yet how impactful this would be.
Yeah, thanks very much for that, Brian. And changes to Japan's inheritance tax laws have certainly sparked quite an intense debate in recent years. And I think it's positive, though, that at least moves are being made to try and improve the system. But as you mentioned, though, whether or not the changes are going to result in a meaningful impact, encouraging more talent within the financial services industry to onshore and spend their time in Japan, I think that remains to be seen. So with that, let's leave behind financial services, related matters, and head to the final couple of items from the tax reform proposals that we wanted to cover today. And these relate to the treatment of NOLs, net operating losses, and also some changes to aspects of the M&A tax system. So let's begin with NOLs. And Ken, if I can bring you back again, please, I'd be grateful if you could take us through these proposals for net operating loss utilization.
Thanks, David. As many of our attendees today are aware, the utilization of carry-forward tax losses is limited to 50% of current year taxable income. The proposal will temporarily suspend the 50% limitation for tax losses incurred in certain fiscal years where specified conditions are satisfied. Many of our clients have asked us whether the suspension will apply to all companies, and the short answer is no. And to understand the reason for this, we need to look at the policy behind the proposal. Companies have been severely impacted by COVID and may have significant balances of carried forward tax losses. Such companies may be reluctant to make investments to restructure their businesses to deal with the impact of COVID if this results in further tax losses being incurred, which potentially cannot be recovered due to the current 50% utilization limit in 10-year carry-forward period. The proposal is intended to encourage such companies to make necessary investments, implement restructuring plans, or undertake management reforms to recover from COVID and to strengthen their competitiveness.
Yeah, thanks, Ken. That's useful to know. And so can you please outline the conditions that would or that should be satisfied for a company to be able to deduct tax losses in excess of the 50% limitation?
Yes, there are three conditions. First, the company must be a blue form taxpayer. Second, the company has filed a business adaptation plan under the amended ICE Act, which has been certified within 1 year from the effective date of this act. In essence, this plan should outline how the company plans to respond to the significant impact on its business due to changes in economic and social circumstances caused by COVID. And third, the business adaptation plan is implemented in a manner which meets certain standards. Now, if all these conditions are satisfied, tax losses incurred during a fiscal year, including any date during the period from 1 April 2020 to 1 April 2021, are treated as special tax losses. In certain cases, the relevant dates may be fiscal years between 1 February 2020 and 31 March 2020 and the following fiscal year.
Yeah, thanks, Ken. And the special tax losses you mentioned are treated differently compared to ordinary tax losses, is that correct?
Yes, David, they are. During the applicable fiscal year, special tax losses can be deducted in excess of the 50% limitation to 100% of taxable income. An applicable fiscal year is defined as a fiscal year which meets all the conditions set out in this slide. 1, the fiscal year commences within 5 years from the beginning of the base year, which is the first fiscal year during which taxable income is generated after the fiscal years when special tax losses were incurred. 2, the fiscal year is included within the implementation period specified in the business adaptation plan. And 3, the fiscal year commences on or before 1 April 2026.
And is there any limitation on the amount of special tax losses that can be deducted?
Yes, there is, David. The amount of special tax losses that can be deducted in a particular applicable fiscal year is limited to the cumulative investment balance, which is the difference between the total amount of investments made under the business adaptation plan and the amount of special tax losses in excess of the 50% limitation previously deducted.
Sorry, I think, Ken, I got
detailed information.
a difficulty with my mic there. Sorry, Ken, I think I had difficulty with my mic there. If I can, I had a question for you there. I think we've seen, the devil is always in the detail, I think, as we saw in relation to some of the previous proposals we spoke about already today. So do we have any details regarding how a company can have its business adaptation plan actually certified, and what the process is for claiming special tax losses above this 50% limitation?
Okay, so detailed information has not been issued yet, and is likely to become available after the new tax laws have been enacted and the tax or other relevant authorities have issued guidelines or regulations. However, we expect the process will follow something similar to what's illustrated in this slide. So first, the company prepares and submits its business adaptation plan to the ministry having jurisdiction over its business. And based on information provided by METI, the plan should include details of the measures the company intends to implement post-COVID, required investments and relevant business performance KPIs. For example, a return on assets of 5% or more. Next, if the ministry approves it, it will certify the plan. Then the company will implement the plan and submit its investment performance to the relevant ministry. And if the ministry agrees that the investment performance is in line with the business adaptation plan, it will issue a certificate. And finally, the company will attach this certificate to its corporate tax return to support the deduction of special tax losses. Back to you, David.
Okay, thank you, Ken. And I'm not going to let you off the hook yet, as I'd like us now to finish up by taking a look at the developments I mentioned earlier in the M&A space. So can you stay with us, please, and take us through what's been happening in terms of these transactions?
Yes, certainly, David. Currently, the ICE Act provides a regime to promote business restructurings between, in general, unrelated companies in order to maintain or strengthen their competitiveness. Now, aligned with this regime, the current tax law provides that where corporate or individual shareholders to an acquiring company in exchange for shares of the acquiring company, a gain or loss on the transfer can be deferred if two conditions are satisfied. The first condition is that the transfer of shares occurs under a business plan for special business restructuring of the target company, which has been approved under the ICE Act. And the second condition is that only shares of the acquiring company are given as consideration to the shareholders of the target company. However, business restructurings under the ICE Act have not been widely adopted. So to further encourage companies to restructure their businesses, the Companies Act has been amended to introduce a replacement regime referred to as the stock allocation system, which will be effective from 1 March this year. And to align with the stock allocation system under the Companies Act, new tax measures will be introduced to defer the recognition of gains or losses by shareholders transferring their shares in exchange for shares in an acquiring company. The new tax laws will replace the existing tax deferral regime with two key differences. So in the example on this slide, Company A intends to acquire shares in Company B by issuing treasury stock to the shareholders of Company B. The new tax laws will eliminate the administrative hurdle of submitting and obtaining approval of a business plan for special restructuring of Company B under the ICE Act. And further, the new tax laws will allow up to 20% of the consideration paid to shareholders of Company B in other forms, for example, cash. Now, although tax deferral will be applicable only to the portion of gains or losses attributable to shares issued by Company A, this may increase the attractiveness of the business restructuring for Company B shareholders. But generally speaking, their approval would be required.
Thank you for that, Ken. But other than the stock allocation system that you mentioned, the Japanese Companies Act also provides other mechanisms by which a company can acquire the business of another company or the shares of another company by issuing shares as consideration, and tax deferral treatment is also available provided that certain conditions are satisfied. So how does the stock allocation system differ from these other regimes that Japan has under the company law?
A good question, David. I think you're referring to a share-for-share exchange and an investment in kind. So first, let's look at the share-for-share exchange, under which Company A can acquire 100% of the shares of Company B by issuing only shares to the shareholders of Company B. Now, if tax qualified, the share-for-share exchange is tax deferred for both Company B and its shareholders. But if Company A and Company B are unrelated, there are several conditions which should be satisfied for tax qualified treatment. And by comparison, the stock allocation system can be used where Company A intends to acquire more than 50% of the voting rights of Company B. And in addition, Company A can deliver up to 20% of consideration to shareholders of Company B in a form other than Company A shares. So the stock allocation system provides more flexibility than a share-for-share exchange in cases where it is not possible to acquire 100% of the company or its shareholders wish to receive some cash consideration. And finally, if Company A and Company B are unrelated, there are less conditions for tax-deferred treatment in a share-for-share exchange. Next, investment in kind transaction, whereby the shareholders of Company B contribute their shares in Company B to Company A in exchange for shares issued by Company A. But generally speaking, an investment in kind is administratively difficult to implement due to the necessary legal procedures. For example, a court inspection to validate the value of the contributed assets. It's expected that the legal procedures for the stock allocation system will be significantly simpler. In addition, for an investment in kind to be treated as tax qualified, meaning tax deferred treatment for Company B shareholders, only Company A shares can be given as consideration, and there may also be other conditions which need to be satisfied if the transaction occurs between unrelated parties. So the stock allocation system provides more flexibility in terms of the type of consideration which can be given to shareholders, and where the parties to the transaction are unrelated, less conditions to be satisfied for tax qualified treatment.
Okay, thanks, Ken. And finally, in the context of inbound investment into Japan, which is of course the the theme and the context for today's webinar, and I think the interests of our listeners, will the stock allocation system apply to a foreign company which is disposing of shares in a Japanese company?
Unfortunately, no. The deferral of any gain will be allowed only to the extent that the relevant shares are attributable to a permanent establishment of a foreign company seller in Japan. And this can be contrasted to a share-for-share exchange, which, if tax qualified, provides tax-deferred treatment for foreign company shareholders. However, provided a foreign company shareholder is tax resident in a Japan tax treaty partner country, which exempts Japanese tax on gains from share disposals, the lack of a tax deferral under the stock allocation system may not have any practical impact.
Okay, thank you, Ken. Well, look, we're almost at the top of the hour now, so I think with that, thanks very much, Stephen, Brian, Ken, and Srini. This brings us to the end of the formal part of our discussion. I think that we just got 1 minute, and we've had a few questions have come in, so I'd just like to deal with one or two of those if we can. Brian, if you're still there, I think this is one for you on inheritance tax, which is a perennially popular popular topic among our foreign listeners. So, in the inheritance tax example, you mentioned the visa type was a factor. So can you explain, please, what that means around visa type?
Sure, Dave. Sorry, you were a little bit difficult to hear, but it sounded like the question was around the issue about visa type in inheritance tax. Yeah, so the visa type is important from an inheritance tax perspective because it's the exemption that's available on overseas property is only available when foreign nationals domiciled in Japan hold one of several specific types of visas, and which tend to be temporary in nature. So work-related visas tend to fit into this category. In contrast, permanent resident or spouse visas do not. So the exemption would not be available for individuals holding those visas. So the visa type does make a difference in terms of the inheritance tax application.
Okay, thank you for that, Brian. Look, that takes us to the top of the hour, so I'm afraid that is unfortunately all we have time for today. So once again, Stephen, Brian, Ken, and Srini, thank you, and special thanks, of course, to all of you in the audience who were able to dial in and join us today. We would like to encourage you to fill out the short survey that will pop up on your screens momentarily and tell us what you think about today's webcast. If you joined late, please note that this presentation, like all other debriefs, will be archived for future viewing. And if you feel that others would benefit from this webcast, please do share the webcast using the share this icon or have them visit the debriefs website. And we will respond to all of the questions that were submitted during the course of the webcast over the next couple of weeks. Also, if you think of any other questions or comments later on, please do feel free to reach out either to me or to any of my other fellow presenters today, and we would be delighted to talk to you. And please don't forget to tune in to our next scheduled webcast from the Geography Update series. And this is on the 23rd of February and is titled India's New Labour Codes, Prepare for the Challenges Ahead. So at last, from all of us here at Deloitte, thank you for your participation in Deloitte's Asia Pacific Tax webcast today. Goodbye.